Hi, I'm Thomas. Welcome to another lecture of financial institutions and markets. Today's topic is the financial system and the aggregate economy. First, let's talk about economic reconciliation. How does the financial system help to reconcile the economy? The aggregate economy, aggregate meaning the total economy, in the aggregate economy, income equals expenditures. There's a balance in the overall economy. And the overall economy has four main components: consumer spending, investment, which refers to business activity, government expenditures, and net exports. Net exports is the difference between exports and imports, or exports minus imports. Those are the four main components of the aggregate or overall economy. There's always a balance between income and expenditures at the aggregate level. However, in individual sectors, the four sectors are consumer spending, investment, government expenditures, and net exports. In the individual sectors, income will not equal expenditures. If income is greater than expenditures, we call this a surplus. And if we have the opposite situation, income is less than expenditures, we call this a deficit. And the financial system reconciles the surpluses and deficits of the individual sectors through financial assets. So let's look at a simple example. In this example, we have our activity in the four sectors of consumer spending, $30,000 surplus, investment activity or business activity, $20,000 deficit, government expenditures, $60,000 deficit, and net exports, $50,000 surplus. That means that exports are greater than imports by an amount of $50,000. So again, we have, let's go back to our totals. I have surplus amounts of 80,000 and deficit amounts of the same amount, 80,000. And I have a balance in my aggregate economy. At the bottom I see my result. The financial assets work to create this balance. In the consumers and the net exports sectors, we have investors or investment of $80,000. And in the business and the government sectors, or the investment and the government sectors, we have borrowings of $80,000. Now, the reference to borrowings, that could be debt or that could be an issuance of equity. But the balance here is we have some sources of capital and we have an offsetting use of capital. A source of capital of 80,000, a use of capital of 80,000. And this, in this theoretical presentation, the concept of net exports isn't really an entity. Net exports really relates to businesses. The amount exported by businesses is greater than the amount imported by businesses, so there's going to be some offset there between the net exports category and the businesses category, or in some cases a combination. But to understand how our four sectors work together, we see here our balance. There's an $80,000 need and there's an $80,000 surplus, and those balance out so that the aggregate economy has a balance. We're using the term financial assets, so let's clarify, what do we mean by financial assets? Let's compare to real assets. Real assets are what we mean generally when we're talking about assets. These are used to directly generate income for a company. For example, a building. I can use a building, I can set up a factory in a building, or I can set up a store in a building and generate income. Or I could rent a building out and generate income through rental receipts. A building is an example of a real asset. Machines, inventory, others as well. We use real assets as a direct way to generate income. Financial assets indirectly generate income. Financial assets represent an interest in the cash flows, an interest in the economic activity of real assets. Shares in a corporation represent an ownership percentage of that corporation. So if I own 10% of a corporation, That corporation has buildings, inventory, etc. They're using real assets to generate income, and then I have the residual rights to 10% of that company's activity. 10% of the income, eventually 10% of the assets once that company is liquidated. Loans represent the right to cash flows of a company based on loan terms. A lender isn't an owner in a company. A lender doesn't have a percentage ownership or an ownership stake in a company. Rather, a lender, based on loan terms, has the right to receive some of the cash flow coming into the corporation as a result of real assets. Again, the lender has a financial asset, which is an indirect interest in the cash flow of the company. The assets generate cash flow, the assets generate income, and I'm talking about the real assets. That's a direct connection, a direct relationship. And then indirectly, as a result of that economic activity, an owner who has a percentage ownership in the corporation or a lender who has a loan agreement with that corporation indirectly benefits from the real asset activity. Let's look at an additional relationship between financial activity and aggregate demand. What we've seen so far is that aggregate demand drives financial activity. When there's an imbalance in sectors, then financial assets are used to create balance. We're also going to see that financial assets can actually drive aggregate demand. So it can be an inverse relationship. First the financial activity, and then the resulting aggregate demand. Let's take a closer look at this concept. Here we're going to see relationships among four components that relate to money and the aggregate economy. So our four variables are M, which is the money supply, V, which is the speed of money, velocity, how quickly money moves, P is price levels, and Y equals output. P and Y have a close relationship. P is a currency amount, a monetary amount, and output is a unit number. And when we multiply P times Y, we have GDP, or what we could refer to as total output. So notice Y as a variable represents output, which is a unit number, not a dollar, not a financial amount. And when we multiply P and Y, we get total output, which is a financial amount. So note the difference between output, which is the variable Y, and total output, which is the result of P times Y. We can also refer to that as GDP, gross domestic product. And so our formulas are M times V equals P times Y, or in another form, the same formula, just moved around, V equals PY or P times Y divided by M. Let's look at an example. Here we have a situation with GDP of $42 billion and the money supply is $30 billion. And we're in this case talking about an annual GDP. So what is our velocity? Well, to generate $42 billion in GDP with $30 billion in money, we divide GDP divided by money to get to a velocity of 1.4. Notice velocity isn't a dollar amount, it's a ratio, it's a relationship. So here we see that we're using our money more than one time a year. We generate more GDP than we have money in the money supply. Let's look at another money and spending concept which relates to growth rates. Now we're not looking at dollar amounts, we're looking at growth over a one-year period. So our formula now, instead of multiplication, is addition. M plus V equals P plus Y when we have the growth rates. So our output growth, again, not total output, just the unit numbers of goods and services. Output growth is 5.4% in the year. The money supply growth is 6.1% during the year. And we have no change in velocity. Whatever velocity was last year is going to be the same this year. So let's calculate inflation. Inflation is represented by the variable P, which is our price growth. So using our formula, M plus V, 0.061 plus 0 equals P plus Y. P is the unknown, P plus 0.054. And we use some algebra to solve for P. P equals 0.061 plus 0, which is the other side of the equation, minus 0.054. We subtracted that 0.054 from both sides of the equation, and the result is a P of 0.007, which means that our inflation or our price growth is 0.7%. We will conclude this video with some analysis, and in the next video we're going to answer these questions and then continue on with additional content. So let's do an analysis regarding money and spending. Looking at the formula we were just analyzing, thinking about these individual variables and how they relate to one another. First, who controls the money supply? Who decides how much money is in an economy? Second, what drives the level of output? What creates an increase in the level of output? Is it possible to increase output? Third, what drives prices? In the last example, we calculated the price increase based on some givens. Is that always the way prices work, or could we simply be given a price increase and use that to calculate one of the other variables? 4, what happens if the money supply is increased but output level does not increase? So here we have some information about 2 variables of the 4. What is the result if the money supply is increased and the output level does not change? And then finally, how does a change in velocity affect inflation? And remember back to the previous example, inflation is simply the P, the price variable of the 4 variables that we're working with. So think about those questions. You might want to do some research on those questions on your own. And then when we come back in the second half of this lesson, we're going to answer those questions, and then we will continue on with some additional analysis. I'll see you back shortly.